Hello, welcome to the Saving with Steve show, where we talk about the ins and outs of money. Pretty much everything under the sun relates to you having a happier, healthier relationship with money. My name is Steve Sexton. I want to thank you for joining us today. I want to thank you for sharing this with your friends, your family, your associates. We're well over 600,000 listeners just here in the United States, and we're close to over 100,000 overseas, and it keeps growing, and it wouldn't grow without you. So thank you again. Today, we've got a real special show for you. One, our viewers and listeners' blogs have been just blowing up, and they want to understand what's going on with reverse mortgage as it relates to a higher interest rate environment, and a whole bunch of other things. So we have Angela Wyckoff. She's a 20-year mortgage industry specialist, and she's a person who understands what's going on, what's necessary to obtain a loan or use loan products that are unique to your situation. More importantly, she's an educator. She educates people about the whole borrowing process to really walk people through this intimidating process of obtaining a home loan, whether it's a reverse mortgage or what have you. So with that, I want to welcome you all to the show. I'm also going to be talking about the state of retirement, and I'm going to give you some really interesting things to think about when it comes to what's going on in the market today. So with that, I want to introduce you to Angela Wyckoff. Angela, welcome to the show.
Thank you for having me, Steve. How you doing today?
I am doing wonderfully well. Like I said before, it's a little going crazy trying to get everything's taken care of. But what I'd like to do is just start talking a little bit about, how did you get into this crazy business, reverse mortgages?
So my passion for seniors started when I was 13. So I had to, and I mark 13 down in my book because we had to move in with my grandmother, who was the sole caregiver for my great grandmother. And I just watched her struggle. She was 4'9", and she struggled to just, help feed her and clothe her and change bedding and etc. So it was a real physical, not only that, but emotional drain on her. And eventually it got too much, and she had to put her in a convalescent home. And fortunately, it was in town and we visited her often. But when we walked in, it was almost like walking in the freezer department in Costco. It was super cold. She'd be screaming and begging us to take her home. She would refuse medications, eventually stopped eating, and she passed away within 6 months. So had we had a reverse mortgage and the ability to bring care to her, her end of life experience would have been dramatically different. So that's where my passion lies. And I always have the senior's best interest at heart, because people can make a lot of money doing reverse mortgage, but that's not my goal. My goal is to make sure that the loan fits their particular needs, because you're going to call an 800 number, you're going to get an unlicensed representative, and the only thing that they have in mind is to maximize company profits. They want to throw a bulk sum of money at you and send you on your merry way. But I dig down to the heart of the situation. What is the money needed for, and how can we make it last the longest? Because if you take that lump sum and run, that's it. But if you spread it out and you build a line of credit, or you set up monthly payments to offset a shortfall each month, that money's going to last so much longer. I had a particular situation where a gentleman called me because his son was like, "What did you just do? You reached out to so-and-so about a reverse, but you didn't even ask me." So he's all like, "Please talk to my dad." I talked to him, and he had called an 800 number, and they were like, "Here's 200,000." And he was perfectly happy with that, and I could say nothing to change his mind. Well, I was all like, "Let's talk about what you're really going to do with that money. What's your plan?" And he goes, "Well, I need 30,000 to fix the roof, do some things around the house, and then I'm going to put the rest in my savings account, and I'm going to draw from it $1,000 a month for my wife's long-term care policy." His wife had Parkinson's. So I was all like, "Gosh, you know what? I could take that equity that you have. I could give you the 30,000 at closing. I can give you 1,500 a month, for the tenure of however long you live in the property. And by age 100, he'll have received 478,000 versus taking the initial 200,000. Now, I'll make less money, which is fine, but he will save interest, $12,000 the first year alone. I literally had to convince him to take something, that would be more impactful to him versus, because I told him I could give you the same loan. I can give you 200,000, but that's not the best way to make this money last for you.
That's great. That's a wonderful story. So here's one of the things we've just got. I've got these list of little questions that I've got here. So I just want to kind of ask, and these are some of the statements that some people have made. And one of the big questions here are, okay, so what are the rules for living? If you leave the house, how long? For example, we've seen well, let's go with that one first.
Okay, great. So the rules are it must be a primary residence. If you have a married couple and one has to go to assisted living, that's fine as long as one borrower remains in the property. If the last borrower does need care, off-site, shall we say, they just need to notify the lender of their stay. So for instance, if it's going to be a temporary stay, 3 months, 6 months, just let the lender know and they will keep your reverse mortgage in place. The problem is that there's an annual occupancy certificate that's sent out each year. And when you don't fill it out, they're going to start calling, they're going to start checking, they might even send someone to knock on the door. You want to keep the lender informed. Rule number 2 is pay your property taxes and your hazard insurance. That's super important. Anything that would cause a default on the loan. So obviously, you have to do that with any mortgage. So it's really important to make sure that those items are paid. They are not typically handled through the reverse mortgage. We can see if there's enough equity to set it up, but it's not like standard. The
Okay.
third rule is that you have to maintain the property. The city can't come by and condemn you or put a, notice of inhabitation or, unable to live there. So if you are living in a 2-story home on a 5-acre property, that might be a little difficult as you age to maintain. So then we might actually continue the conversation on maybe it's better to use a reverse mortgage to purchase a right-sized home instead.
Oh, I see. Okay. Now the next thing is everybody's worried about, we've got high real estate prices right now. If they get a reverse mortgage and the real estate prices go down below what the actual mortgage value is, what happens when somebody passes away? What's the impact on the family? What are they going to have to pay the difference in the mortgage? What's going to happen there?
So that is an amazing question, and I get that asked all the time because first off, everybody thinks that the bank owns your home, which it does not. You still have ownership to the property, just like you would with any other mortgage lien. The most important thing to know is that these high interest rates are something you should take advantage of because we have high values and we have high interest rates. This right now is like the perfect storm for the growth of your line of credit. So there's many ways to structure a reverse mortgage. One is a lump sum, one is setting up a monthly payment, and 3 is a HELOC, or I should say HECM, home equity conversion mortgage, or you can do a combination of the 3. Now, that home equity conversion mortgage takes a portion of your equity and it opens it up for you in the form of a line of credit. The longer you stay in the property, the more access to funds that you have because they don't want people to refinance as the values increase, right? They want to assume a 4% appreciation of your home. And then every year as you age, you gain more access to those funds. The growth rate is going to be the interest rate plus 0.5%. And so the longer you let it sit there, the bigger it gets. And you can withdraw that money at any time, even if there's another market crash. So, for instance, if anyone was around during the 2007 2008 mortgage meltdown, I was there. And the happiest people on the block were the people that had a reverse mortgage. Everybody else had their HELOCs turned off. Banks were drawing back on funds, not allowing you access. But the reverse mortgage is not the case. The reverse mortgage is a non-recourse loan. So that's very important to understand. Typical reverse mortgages require a 2% upfront mortgage insurance premium. That's why everybody complains that they're so expensive. For instance, I have someone right now who's buying $1 million property. There is a $20,000 mortgage insurance premium that's collected up front and then a 0.5% per month. These are protections in place for you. So you pay $20,000 up front, and let's say as your balance increases, you end up owing more than the property is worth, and you no longer need the reverse mortgage because you've either left the property vertically or horizontally. There's only two ways to leave it, right? And let's say her balance is now 3.8 million, but the property never appreciates past 1.8 million. So there's a $2 million deficit there. Who's going to pay that? You already took care of it. You paid for 2% insurance up front. That 20 grand wiped out $2 million worth of debt. Nobody's going to get a bill for that.
Oh, that's
So
wonderful.
yeah, it's such an amazing retirement tool. I can't say enough great things about it. Your bills are never going to get an heir. You're not leaving them debt. If anything, you're giving the ability to age in place successfully and in the comfort of your own home. And most people are saying, you know what, my children are successful. They don't expect anything and they don't want my house. Great. Live in there until you no longer live in there. And then it's a wash.
Angela, stick right that thought. Everybody stick with us. We're gonna be right back with more Saving with Steve. Okay, perfect. Cameron, that was the end of segment number 1. That was wonderful, Angela.
Thank you.
And those are good questions. So here we go. Cameron, we're going to be moving into segment number 2 with Angela Wyckoff. Again, episode 137. And so let's see, I got my little lovely intro here. So here we go. We got a little 5, 4, 3, 2, 1. Hey, welcome back to the Saving with Steve show, where we talk about the ins and outs of money. I again want to truly thank you for joining us and appreciate you sharing us with your friends and family. All the replays are available at www.savingwithsteve.us. If you're enjoying the stories of helpful information and insights on Saving with Steve, then I encourage you to subscribe to our YouTube channel. Never miss a show. Again, check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio, New York City, E360 TV, Las Vegas TV Network. All these networks are dedicated to empowering you to solve problems, uplift your spirit, and live a life of personal financial freedom. Also, follow us on Facebook at Saving with Steve Sexton. We're at the Insiders Club. You can get guest gifts, behind the scene things where everybody fouls up and has fun. And with that, we've got some more Angela Wyckoff, and we are talking about reverse mortgages. So one of the big things, Angela, that I want to talk to you about here is this. Now, I know that if the mortgage is upside down, okay, and there's some people who said, hey, is this true? So here's the scenario. Let's just go back to 2008, and we could be right there again if there's a housing crash. But so in 2008, we saw housing prices that were really, really high, and then they dropped. There was one caveat that somebody told me about, and a few of our listeners said, hey, what about this? If the current appraisal of the house is, whether it's be less than the mortgage or more than the mortgage, the heirs have the ability to buy the house for 95% of the appraised value at the time of death. Is that correct? Could you explain it to everybody?
Absolutely correct. So yes, the lender can never recoup more than the property is worth. So if the property is upside down through the reverse mortgage, that's still okay, because it's that mortgage insurance that protects the heirs from ever owing more than the property is worth. And then the heirs have the ability to purchase at 95% of present market day value. So let's take the instance that I had with the purchase that's going on right now. Let's say they owe 1.8, or let's say they owe that 3.8 million, but the property is only worth 1.8. The heirs can buy it for 95% of present market value, and they're not going to have a bill for the overage. It's amazing. It's awesome. If you want to keep the house in the family, that's the best way to do it. And then if the heirs are age eligible, they could potentially get their own reverse mortgage. Of course, they'd have to put a chunk down based off, their age or what have you, but definitely an amazing way to use a reverse mortgage to keep that property in the family.
You know what? What's really interesting is one of the people who wrote into the show, one of the listeners, and I want to thank Judy for doing this. She had explained that in 2006, her relative took out a reverse mortgage on a $900,000 home, and the value of the home dropped down to about 350, and it was appraised at 95% of that, and all the heirs went and bought the home for less than $350,000.
Yes.
And ended up selling it 3 years later for almost $800,000. And it was a wonderful economic situation that they were able to truly profit from their relative
Yes.
demise. But it was like, wow, because they all thought they were just going to have to give up the house until somebody told them that. So it was just real interesting. And it was, some people are asking that question because I want to make sure it's true.
Yeah, absolutely. 100% true.
So now, here's one of the questions that we have. Some people, they go and get a reverse mortgage. They end up getting an inheritance or two. They don't want the reverse mortgage anymore. Okay. So what's the process for, hey, paying off a reverse mortgage and moving on?
So you are in control of your reverse mortgage. You can purchase a property using a reverse mortgage. You could refinance. You could pay it off at any time. The longer you stay in the loan, the more cost effective it is because of the upfront charges. However, 10 years down the road, if you want to sell the property and, travel Europe, you're more than welcome to do so. You can pay off the lien at any time. So if you receive an inheritance and you would like to pay it off and then have a free and clear property again, I don't know why you would do that. I would still take advantage of that growth of the line of credit, but you can definitely have the power. There's no prepayment penalties. There's no requirement to stay in the loan for any length of time. We do ask that, we want to make sure that it's cost effective for you. So if it's not a temporary band-aid, like if you're not planning on living there for the next 3 to 5 years, I wouldn't recommend a reverse mortgage. It's not cost effective. If you are staying there for 10 to 15 years, then yes, it could potentially be a good solution.
Okay. Now here's the next question. When somebody goes into a reverse mortgage, there's always fees. You talked about mortgage insurance, and that's the biggest fee. Now, what are the other fees, and is there ways for people to reduce those things, or, it is what it is?
So the 2% mortgage insurance is only for the adjustable rate. Now, about 98% of reverse mortgages are adjustable. And the reason is because of that line of credit and the growth that it offers. In 10 years, most of my clients will have doubled their line of credit. For instance, I put my mother-in-law in a reverse mortgage and she started with $145,000. In 10 years, it'll be over $300,000 untouched. So you can use money from it and pay it back, much like a credit card, if you'd like. Let's go back to the fees. Got it. So the mortgage insurance, again, protects the heirs from ever owing more than the property is worth. It's an insurance policy. You never get a refund on your car insurance or your home insurance. You don't use those typically. You don't have a claim as frequently. Same thing with the mortgage insurance. The mortgage insurance protects you and your heirs. You pay the one-time upfront and it's financed. Then there's a 0.5% that's collected each month. And that 0.5% actually protects whatever was promised to you from day one. So access to the line of credit that will not be turned off unless you default. And then payments, like if you scheduled payments for $500 a month to come to you each month and the values tank, that 0.5% that you are accruing each month is what protects you from a market crash.
Okay. Now,
and let me go back. I'm sorry. The fees. You were talking about the fees. So the 0.5% mortgage insurance collected each month, the 2% upfront, which is financed. The loan origination fee goes to whatever broker is helping you out, and then the title and escrow fees are going to be standard for like any mortgage transaction. The borrower can choose their own title company. However, I would caution you on that. I have relationships with certain title companies that offer us discounted fees, and they know how to process a reverse mortgage. Not every escrow and title company does.
Okay, that's good to know. That's good to know. Now, some of the things that people have a concern with are, okay, obviously if the house is falling down, you're not going to get a reverse mortgage. What is the financial criteria? Where does somebody have to be in order to qualify for a reverse mortgage? Because, let's be candid, if somebody can't afford the property taxes or the insurance, it's not likely they're going to be able to afford get a reverse mortgage. But so what's the criteria?
So it's very different from qualifying for a forward mortgage or a conventional loan because there's no payment, there's no required payment. So we don't have to take that into account, but we do have to take into account the residual income. So we want to make sure that they can keep their electricity on and hot water and all of that. So there's a calculation, and most people qualify just off what they receive for Social Security. Now, let's say, for instance, somebody's only receiving $800 in Social Security, and based off of the life expectancy and the count of how many people live in the home, et cetera, and maybe they have a monthly payment of a credit card. So let's say they're short by like $200 to qualify. If they have any assets, like let's say, for instance, they have a managed portfolio that they don't have to touch. Let's just say they have $200,000 sitting in an account that maybe they're not touching it just yet because they don't have an RMD required. We can use that account, that 200,000, to offset the shortage in their residual income test. They do not have to move that money anywhere. It's literally just show me that you have this access to funds, and it's called asset depletion. Also, if they're receiving proceeds from the loan, we could use proceeds as a qualifying and compensating factor. So this loan is super unique. It's definitely worth a conversation. Please don't call an 800 number. Please call a licensed professional like myself, and then we can talk about your options.
Okay. So last but not least, if somebody owns a home, they might not qualify for it because they got $800 coming in from Social Security. But if they sell that home, they'll have $200,000 in cash. Would they be able to go buy another home using a reverse mortgage with having that cash in the Social Security, providing they meet the income? Okay, that's great, because that was another question. What can I do to put myself in a position? Because there's a lot of people who are looking to downsize and maybe get something smaller, but still want to be available if they have to make that transition. So now, Angela, here's a big thing. We're coming to the end of our time. I'd love for you to let everybody know how they can get a hold of you if they'd like to get information or education about reverse mortgages.
Absolutely. I have the simplest way to get a hold of me. Go to ilovereverse.com. ilovereverse.com is a secure portal where you do not have to put in your information or sign up for a subscription. You can go there to find a way to contact me, to send me an email. You can also send it to angela@reverseloansolutions.com. But you go to ilovereverse.com, there is information on Social Security. There's information on how to get in the opt-in or the opt-out pre-screen so that you don't get sales calls. There's a lot of great information in there. Previous podcasts that I've been on, FAQs. So please do me a favor, do yourself a favor, go to ilovereverse.com, get some education, and then there is a contact me button there, and I'd be happy to have a conversation and see how a reverse mortgage can best fit your needs.
Angela, thanks for being with us today. We'd love to have you back sometime. And I want to say stay safe, stay healthy, and everybody. What is that portal everybody goes to?
ilovereverse.com.
ilovereverse.com. Thank you so much, Angela. Look forward to seeing you next time.
You're welcome. Thank you for having me.
Hey, welcome back to the Saving with Steve show. Wasn't Angela wonderful? So one of the big things I want to talk about today is what's going on in the market. I want you to think about something here. Okay. And what's happening with me is I'm getting flashbacks to the 1990s. So what's been going on with the market since February of this year? You know what? The market's been coming back. You know what? In fact, if you go back to November of 2021, you know what? The market was at like 4,800 for the S&P. Now it's getting pretty close to that. Many of you who haven't earned anything for almost 3 years are at a point where your stocks are valued, but their portfolio might be lower because you've been taking money out of it. Okay. Big question here is, you know what? Many of you after 2.5 years are almost back to zero from the stock price. Okay. And folks, what has been driving all that? Give you a hint. It's two letters. AI, artificial intelligence is driving the market. Specifically, if you look at the S&P, there's 5, maybe 6 companies that have been driving the bulk of the growth, and they're all focused on AI. And you know what? And they've been driving the market upward, and it's reminding me of the late 1990s. So let's just talk a little bit about the late 1990s, like 1999. Remember what happened? Okay, we bought stocks that didn't make a penny. We had unrealistic expectations, irrational exuberance on the direction of the market moving forward. Everything, every bell was ringing and nobody was listening. See, one of the things we didn't have today, we have things that we didn't have in the late 1990s. We have incredible markers, okay? 1990s, we had GPS. We barely used our cell phones. You know what? We had incredible things like the Schuler PE ratio, Warren Buffett's market cap versus GDP, and they were in their infancy back then. Now they're staples. Now, these technical reports are showing that if you look at the Schuler PE ratio, the market is trading at 30 times its price earnings, when the typical market is trading, a good market, a great market is 15, 16. So we've got an overvalued market. The market cap versus GDP is at 167 today. And you know what? Anything over 135 is the market is significantly overvalued. And if you compare that to what's going on, it means the market is really out of whack. Okay. So, oh, hey, Cameron, cut this thing. Okay, so I'm going to go back one sentence, okay, where it's going to say these technical reports. So these technical reports, Schuler PE ratio, market cap for GDP, are all showing that the market is vastly overvalued. And it's completely out of whack versus what's going on right now. You know what? We're in a repeat of 1990s, not on the same scale, but we're getting there. How old were you back in the 1990s? You know, were you working? You know, it probably didn't mean that much to you because you were working. You had a job to support your lifestyle. But if you're retired, it does today. So the question I have to ask you is, how many of you can afford to gamble on today in with the unrealistic expectations of the market? The fact of the matter is, the number one reason for failing in retirement is not understanding the transition from growth to income. It's not understanding the power of income. Ideally, in retirement, you want to make sure your distributions come from dividends and interest. The last thing you ever want to do in retirement is cannibalize your principal. So the question you might want to ask yourself is, can I afford to gamble on what's going on today with these expectations being unrealistic? So I want to thank you for joining us here today on Saving with Steve. Look forward to seeing you next week. Stay safe, stay healthy. We'll see you next time. Bye-bye.